Hey traders, and welcome to the monster pattern search demonstration and tutorial video. Okay, in this video I will explain you the algorithms that are available in the MPS 5.2. Let's give it the first run. Here it is. Okay, and let's go to the algorithms. So what are the algorithms? They are basically the rules of detecting highest highs and lowest lows, of detecting the pivot points, swing highs, swing lows, or detecting the wave terminations or wave beginning points. So this is what is called the algorithm. Okay, so how many we have? We have 11 Williams percentage range, commodity channel index, RSI, stochastic, price extreme, close price, fractals, ATR, Pip Distance percent, and manual. So depending on what you choose, it will be initially displayed in your graphic interface. You see, you can later switch that to some other algorithm to your preference, yes, or maybe from group 2 algorithm, but initially it is this, because you have it in settings. Okay, let's go back to settings. So let us start from Williams percent range. So what is the Williams percent range? It is the algorithm that looks this way. You choose it to be displayed, and then you go to set it. The Williams percent range period is this 14 candles, and overbought oversold conditions are -20 and -80. So if you set your period to a greater, your algorithm will be less sensitive to minor turns. For example, let's have this 14 period and this 20 and 80 overbought oversold conditions. So the 14 periods picks this small pattern, and if we go to settings and change it to, let's say, 30 period or something of that kind, you see the movements are ignored. These minor movements are ignored, and you have it a bit different way. You only have larger patterns. Okay, the less is the period, the more sensitive it is to your to minor turns. And of course, as I told in my previous video, you can switch this overbought oversold condition to false, and you can switch that zigzag plotting to false. So you see, nothing is drawn. The patterns are drawn, but nothing is drawn as this lines. If they irritate you, you can switch that off. Okay, now let's talk a bit more in details about this algorithm and how it works. Basically, when an overbought condition is met, yes, then we have this dot, and it means that the downside movement stopped and upside movement started. And unlike the commonly believed situation, when you have an overbought condition, this means we should have a sell. It is not true. Look at this. We have overbought condition, but no selling started. We have next overbought condition, next overbought condition, and no selling started. We had some minor correction, then we have overbought. We had some minor correction, then we have overbought. So starting from here and all the way up to the here, we didn't start any significant downside movement. We had some minor here, but no significant movement to the downside, and this is the problem. People don't understand how to use those oscillated overbought oversold conditions. Okay, what you should keep in mind that these overbought oversold conditions are only good in corrections. So you first should have an uptrend. An uptrend is simply the zigzagging formation. So let's start it from here. So we have correction. This is an uptrend. Starting from that movement, we are looking at corrections. An uptrend is a series of impulses in one direction. So if you have two impulses separated by one correction, so you are having an uptrend. Okay, in this uptrend, upside is impulses, downside are corrections. And if you will always buy when you have oversold conditions, then you will buy almost at the low of correction. You see, and then you have it movement rising, 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 and rising. Yes, and then you profit somewhere. I don't know where you profit according to your rules. Then you wait for correction to terminate. You see the movement to the downside started. You see the movement to the downside started here, but this correction didn't terminate and movement expanded to the upside. And then you have that oversold condition one more time. This is the best time to buy it, and you buy it. Yes, and then you have correction started one more time, and you have oversold signal to buy it. This time it failed because price dropped lower. Then you have another signal to buy. This time it won. When it wins, I mean it breaks the previous high. Then you have another signal to buy, and this time it wins. Then you have another signal to buy, and this time it wins. So in an uptrend, when you are going to buy the low of correction, then it is good to wait for a overbought oversold condition. So you are going in the trend direction. But if you will use as a counter trend, this is absolutely useless. You will only lose your money if you sell and the sold conditions. So basically it works this way. So I hope you understand what it is. If you wish to check it, you simply go to choose your oscillators and choose your 1% range, 14, and what are the levels here? Minus 80, minus 20 are standard levels. Okay, and what you see is this. So when the dot first initially appears, this means that the price initially entered the oversold. Then we continue oversold, and then we slightly go out from oversold. So we have these few bars going out from oversold. Then we sink back beyond the water. Then we go out slightly, so we go out slightly, then we sink back. So, and then we go higher, 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 and at this candle we met oversold condition. So you see, we met oversold condition. Then we extend, and then we go lower. So it is the same as you use the 1% range. So you don't need the indicator anymore because the NPS version 5 draws that. Draws overbought oversold conditions. Okay, let's delete this 1% range. Indicators, chart window, delete. Perfect. And as I told you, you can set it in settings. And depending on which settings you set, yes, every time you switch to 1% range, it will be with that settings. What are the settings? 14. Period and 80-20 overbought oversold. Okay, let us switch to another oscillator indicator that is called commodity channel index, and the type of that commodity channel index is this. Again, the period is that 14. We have additional input here, which is a typical price. There is a number of that: close price, open, and so by default, the typical price is the one that is used with commodity channel index, and the second most common is the close price, but you can apply it to whatever you wish. So the typical price is the one that is a default price, and the overbought is 100, oversold is minus 100. And again, it looks similar way. Every time you meet the overbought, the dot is drawn and the swing turns to the upside. And again, if you buy it when it shows over bought condition, you may lose. But sorry, if you sell it in an uptrend, when you have an impulse to the upside and you try to trade counter trends, then you most likely fail. But if you only buy corrections using oversold conditions, so oversold here, you buy it. Yes, oversold here, you buy it. Oversold here, you buy it. Oversold here, you buy it. Oversold here, failed, didn't extend past previous high. Oversold here, good, we did violated the high, oversold here, wonderful movement, oversold here, wonderful movement, we slightly extend, oversold here, then we failed, and then it turns into different direction, so overbought here, we sell it, overbought here, we sell it, and so on and so forth. So this is very basic of oscillator trading. You only use the oscillator to confirm the end of correction. And how do you know what is the correction, what is the impulse? Simply using that zigzagging. It is very, very simple. And of course, this overbought, oversold is a very good complement to your trading. Yes, so maybe in a downtrend you will only look for selling, so overbought, oversold plus pattern will be a very, very good strategy for you. Well, it's all up to you. You just do the market research, do the backtest, and you find your best methods for it. Okay, and as I told you, the preferable settings of Williams percent range stay as you set them, and commodity channel index stay as you set them as well. So in the settings, when you switch in control panel, they are simply the same as you set in your settings. Okay, let us switch to RSI algorithm. It works pretty much the same as all oscillators. It shows overbought, oversold, and in your settings you set it this way. So what I like with RSI, I like the period of RSI being 5, but in majority of cases the period of RSI is 14. Overbought is 70 and 30, and period is 14. The input price is close price, but you can also use typical price, which will make it slightly more smooth. Let's put it this way. Of course, if the period is small, it will be very sensitive to minor turns. If the period is large, it will be not sensitive to minor turns. And you see, I didn't switch that to RSI in settings. That's why my last was CCI, Commodity Channel Index. But if I switch it from here, you see what we have is this. You see, RSI 14 is detecting these large patterns. You see that? RSI 14. So let's go here to this. Let's disable overbought, oversold. Okay. Let's go here. Enable overbought, oversold. So if you are using RSI pretty often, then I advise you to enable it in settings as well. So you use that RSI relative strength. Okay, in this case you will have it precise way. Okay, so what we have is algorithm that is drawn this way. If we enable our RSI from relative strength index, and it should be 14, yes, so levels 30 and 70, you can set that to whatever, 20 and 80, and you will see that every time price hits the overbought condition, you have the dot, overbought condition, upside dot. When you hit the oversold condition, you have an oversold dot. I'd prefer the RSI to be more sensitive. That's why I set the RSI to 5. Let me do it this way. Already understand that it is showing exactly the same. RSI 5 is my preference only, and that's why it is more sensitive to market turns, and it works similar to other algorithms. So what do we have? Of course, if we try to sell counter trend, then you see we have that pattern, yes, and we installed an uptrend, and if you try to sell counter trend, then it's not a good idea. You see, you fail. But if you buy with trend, then it is a good idea, because you have that RSI giving you a signal to buy. It gives you the signal to buy, signal to buy, signal to buy, signal to buy. So in the end of correction, you have a signal to buy, signal to buy, and this is great. Okay, now let's go to another algorithm, which is stochastic algorithm. So I'll switch that to stochastic. It's not mandatory to switch to stochastic in settings as well, because you can switch it here, but you'd better do this if you use stochastic pretty often. Otherwise it will automatically switch to the one that is in settings. For example, you have willing percent range, and your preferable one is stochastic, so you trade with stochastic, and then you change the group and you change it back, and instead of stochastic you installed the willing percent range. So in order not to mess the things up, you'd better have it. Okay, the stochastic, pretty common, pretty conventional period as smoothing and method and overbought oversold condition. So if you're familiar with stochastic, you understand what it means. Basically what stochastic shows, it shows the difference, not the difference, it shows where the close price relative to the total range of the candle. If it closes in top 20, then the candle is powerful bullish. If it closes in bottom 20, then the candle is powerful bearish. And then you use the so-called moving average of your information. So if you have a tendency of more powerful candle, of more powerful bullish candle, or you have a tendency of more powerful bearish candles, and then you have a smoothing factor that is applied to that moving average that is based on your close price, and you have that oscillator as well. Okay, so what is this oscillator? It works pretty much the same way. If you buy corrections when they are oversold in an uptrend, you always have a good entry. Buy a correction when you have stochastic overbought, oversold. But first thing that you need to do, you need to install an uptrend. And as I told you, based on Dow Jones theory, an uptrend is a zigzagging movement like this. When you have a zigzagging movement, then you have an uptrend. And look how many entries you have. You have here, you win it. Simply retest of that high. Yes, retest of this high. Let me put it this way. No, here. You buy it here and you win it, the retest of this high. And you buy it here, you again win. You buy it here, you fail. You did not retest that, you went below this low. You buy it here as overbought, you win the retest of this high. You buy it here, you win. You buy it here, you win. If you place your target at the retest of the high, you win in majority of cases. So you have that very, very nice. The only thing that you need to do basically is to limit your losses. Because if you buy it here and your target is here, in majority of cases your risk to reward was not that very much favorable. So this is your reward and this is your risk, yes, below that thing. It will be a very good entry technique for you. Entry technique if you look at the correction to end, but it is not very good in terms of risk to reward, and if you simply use it as a separate strategy, it requires additional testing. You need to test it. I only show you some of my findings and show you how you can use it, and what exactly you should do is only, of course, depends on your trade plan that you have backtested. Okay, the next algorithm is prex. So let's go to the settings and let us set the prex algorithm. It is simply the price extremes, and it is here. price extremes. By default it is set to 10, but I prefer it to be 30. So what it does, it finds the highest high or lowest low within the period of 13 bars. So we have it this way. So it finds the highest high and lowest lows. Okay. When you switch back to stochastic, your stochastic is saved according to the settings that we set. So when you switch them, they only show you the information that was in settings. Okay, so it is very, very simple. When you go back into history, you can find more and more examples. By the way, the MPS version 5 is the only software that I know that draws the patterns back into history for your backtesting, for your fast backtesting, without the need of typing any number of bars to be backtested or whatever. It understands automatically that you have this new historical data, and you see the patterns when you see that future time, when they appear, no pattern appears, but only when the condition met and you have 127 extension for the cipher, it draws the pattern, and when the condition is invalidated, the cipher disappears. Okay, if the pattern was not invalidated, it stays on the chart no matter what. Okay, now let us switch to group 2, and we will go here, and what I will use is the close price. So the close price is the algorithm number 6, and you go to your close price, and again you set the period. They say that the close price is more valuable than the extreme price of highs and lows because they are basically fluctuations, but what you have in the end of the bar, this is what is important. So if you will use the close prices of your bars, and you will use the highest close price between 10 bars or lowest close price, you can also have an algorithm to detect your swing highs and swing lows. My favorable one is 13 because based on my backtesting, the average swing on whatever market and whatever time frame in Forex and on cryptocurrencies is the 13. I don't know why, but 13 candles is appears to be the average swing in all those markets. So let's save it to 13. Okay, and if we go here, you see it mismatches. Why is it so? Because it is using the close price of the chart. So switch it to close price and you have it. It simply ignores the spikes, and as I told you in the first video, you can use it as a confirmation to your price extreme. So when you see that price extreme, it points you to a cipher, and then you go simply check it. If the close price also finds that cipher, then with some minor differences, yes, which are those spikes to the upside, to the downside, you have the same pattern with some minor difference, but the pattern is the same. So the close price structure coincides with extreme price structure, and this gives you additional confirmation. You can also use the close price with whatever you wish. Okay, so you see that close price. Why it is needed to pay attention to the close price? Because all these patterns were first initially developed using the close price. All those concepts that we have right now, that an uptrend is a series of high, lower lows, or peaks and valleys followed each other. Basically, all these terms were created looking at this simple line chart. So when you have an uptrend, you are looking at this simple line chart, and well, what else can I say? This is the basis to understanding of line chart, and this is the highs and lows. Okay, the next algorithm in the list is the fractals. So what is a fractal? The fractal is this formation that was first introduced by Larry Williams, I suppose, and it looks this way. So imagine this is the candle, another candle, another candle, and this is the candle here and the candle here. Okay, so when you have that formation that sticks out above the two preceding candles and two following candles, then this movement is called a fractal to the upside, and to the downside it is inverse. So what you need to have a high that is higher than previous two and following two. So this is a fractal. You can also apply that fractal indicator from your default Bill Williams fractals. Here are they, and you will have them, the fractal indicator here. So okay, let it stay for now. What happens when you choose this indicator? It has no settings. It is one that has no settings. If you go to try and find it here, you won't have it. It has no settings, so you can simply choose it. So it draws the patterns according to the fractals, and of course it looks kind of messy because the patterns are too small, and that's why I don't think that it is a good idea to trade it based on this time frame. But what you can do is this: you switch that off, yes, and the pattern that is based on daily fractals is one of the most profitable patterns. So you can see them, go into targets, go into targets, go into targets, this one invalidated. So again and again, started the movement earlier, and this one started the movement earlier. If we switch to custom, let's go this way. On, disable this, fractals off, and go here. So I prefer using custom patterns because it is a unified Gartley that I created myself. It is a combination of bat pattern and a cipher and a Gartley pattern. So I prefer it using this way. Instead of bats and Gartleys, I use the unified pattern. Okay, so as you might have noticed, you find the patterns based on daily fractals, and you simply go to execute on smaller time frames. Okay, let's switch that on, and let's go to the next algorithms that we have. Let's disable these fractals. So the next algorithm in the list is this ATR distance, and it is a very wonderful indicator, wonderful algorithm. I will show you. So what are the settings for ATR algorithm? First of all, you need to set the period of ATR. Period 30 is one of the most commonly used for ATR, and of course you need to set the reversal factor, which is the number of ATRs, how far the price in terms of ATR should go for you to start that movement to the upside and movement to the downside. Okay, I will run it for now with 3 ATRs, and we will see what happens here. It is not that sensitive as pretty different indicators when you run the 3 ATR. So how the ATR work? They work very similar to Renko bars. What is a Renko bar? A Renko bar is a type of chart that is drawn not on price, and it is drawn based on price but not based on time. So it ignores time, and whenever price, let's say to the upside, moves one ATR to the upside, it draws a block, simple block, and let's make it green. Simple green block when we move one ATR to the upside. When we move one more to the upside, it draws another block. More, it draws another block. When we have more, it draws another block. When we have more, it draws another block. Okay, so if you move one ATR to the upside, it draws a block. If it doesn't move one ATR, some of them draw a wick, and then may draw something to the downside. Okay, so what happens if after this high you move one ATR to the downside? Basically what happens is this, and the rectangle turns red, but the Renko indicators ignore that fact when you move one ATR to the downside, because you move within the previous range, within the ATR range, and it only starts drawing the movement when you move two ATRs to the downside. You see that? And there are very many strategies that look this way. So this is the Renko chart that looks this way. You can find them almost everywhere. Many charting packages provide these indicators. I suppose I also have some Renko bars in my indicators package. Yes, I have some Renko bars. I don't know, Renko live chart, Renko something, range bars. The difference between Renko and range, that the range is using pips, I suppose. So you just go type ATR and brick 100, and it draws it this way. No, it's not that. It's slightly different. Range bar is slightly different. Magenta, no, it's not. Maybe this one. Box size, time frame 2, it's not that either. Okay, so what is that? Renko chart is the ATRs moving to the upside. Of course you can set the swings. Yes, if you know that those guys that are trading Renko charts, it is also similar to point and figure chart or whatever. When you move the distance, exact distance of that, you can switch your swing identification algorithm. Yes, so when it moves to the upside, delete. When it moves to the upside, you have it this way. When it moves to the downside, you have it this way. When it moves to the upside, you have it this way. When it moves to the downside, you have it this way. And maybe you will have a cipher pattern. Yes, something of this kind. Why not? But what we basically have here, you should keep in mind that here we first move against the last green bar. This is one ATR back, and then we move one more ATR. So this is two ATRs. And if you go to the settings to the MPS 5.2, go to ATR distance and ATR, and you choose the 2, it is basically what is meant. So whenever price moves to ATR back, you have it this way. So those of you who like Renko bars and based on ATRs can have it this variation. The ATR algorithm is one that I called it. Okay, I personally prefer it to be 3 ATR. So not only one ATR red, one block on Renko chart, but additional block that is a confirmation. I remind you that when you have one ATR, no red block appears. When you have 2 ATRs in opposite direction, then only one red block appears. And when you have 3 ATR opposite, then you have a confirmation to the downside. So that's why I prefer it to be 3. 3 ATR. You can also set that as a float number, 2.5 or whatever, 1.5. It's all up to you. Okay, very similar to this is the next algorithm that is called pips, but instead of ATRs, oh, by the way, ATR, we have 3 ATR. When you switch to 4 hour, of course they are 3 ATR based on 4 hour. That's why it is dynamic. So on 1 hour it is 1 hour ATR, unless you switch that off. Yes. When you switch that off and turn it to, where is it, to here, of course it is based on daily information. Okay, now let's go to pipsage. So it is the algorithm that is called Pip Distance, and this is what our range bar is about. Range bars are very similar to Renko bars, but instead of ATRs they are using the range, the predefined range of pips, and it is pretty intuitive. Okay, let us type a range of 100 pips. So simply ignore all the movements that are less than 100 pips. I have 1000 because 100 pips plus 0 because we have 5-digit broker. Simply ignore all the moves that are less than 100 pips. And on daily it looks a bit volatile. Yes, 100 pips on daily is almost nothing. Let us switch to 4 hour, and on 4 hour it is something that is pretty typical. Yes, you see it picks up the majority of the movement, and on 1 hour it will be a larger one. You see that? Because 100 pips for 1 hour is very major swing, but on 4 hour it is something that is a middle swing, and on daily of course 100 pips is a minor turn. Okay, so hope you understood this, and as usual you can prevent that from recalculation and to see the entries on lower time frames. And again, this is the same as Renko bars. So let's say this is 1 hour 100 block, so it moves to the downside until you have opposite to the upside. So you have opposite to the upside, it is 100. Then it turns into green. Yes, the indicator, if you type it 100 then it turns into green, but if you type it as 50, yes, then each and every is 50 pips, and when the price moves 100 against you, this means it moved 50 pips higher and 100 higher. So it is the same as the range bar 50 using 100 block. Okay, so the range bar looks this way. Okay, and now it is time to explain the final algorithm that is called percent algorithm. Let's go back to settings, go to indicator, and the percent algorithm is simply the percent of price. This is the price change of the close price, of course. All the highs and lows are filtered. They don't take part in the calculation. Okay, so this is one of the oldest indicators. This is the classical indicator, and whenever price changes its direction, for example, by default the setting is 1%. Whenever price moves 1% back in opposite direction, then we have swing turning to the downside. If it moves in upside, then we have a swing turn to the upside. So we just switched that. Sorry, we didn't switch that. Percent. Okay, and it is automatically copied here. So 1% is not that very big change on daily, but it is a bit more noticeable on 4 hour. Yes, 1%. Classical percent changing, percent trading is 5% on dailies. So the major trends are those that are 5%. This is kind of classical for percent algorithms. So whenever price changes 5%, then it is this, and they look this way. You see, this is the 5% changes, and the patterns are drawn according to this. If you switch to weekly, 5% is something that can be also used on weekly. Okay, how it is calculated? It is calculated very simple. For example, you have this price of 1566. So what is that? 1.1566. Yes, and you simply minus 5%, and it equals 1.0987. So when price goes from 1.66 to 1.0987, all the way here, 0980, so you have a downswing. When you move it 5%, then you have an upswing. Hope you understood. The calculation is very simple. Okay, so this was a percent algorithm. After all your algorithms are set, what you simply left is just switching between them according to your preferred settings. This to this to this. By default, they are set to complement each other. So William percent, CCI, RSI, and Stochastic, they are set to detect almost the same turning points. So you see, almost the same turning points. So this is the default settings based on my research, based on my, of course, except fractals. Fractals don't have it. ATRs, pips, of course, can be set to your taste. Pips are very different, and percent also can be changed. So you can also use 0.5%, 0.005. So 0.5%, maybe it is slightly hard to see on daily what you have, but on 4 hour it picks up major turns, major pivot points. 0.5%, maybe it is even better on 1 hour. So you have these major turns if you use 0.5% change like this. Okay, well, that's it about the algorithms. Hope you understand what is the logic for those algorithms, how they work, how to set them properly, how can you trade using these algorithms. If you don't even trade the patterns, you can profit from trading simply the information that is provided by those algorithms. Yes, you can simply analyze if you have an uptrend, you can analyze if you have overbought or sold, and so on and so forth. So many other additional stuff aside of patterns. So even without having any patterns, you simply can understand when the correction is ended to enter in this trend continuation trade. Okay, that's it for the algorithms, and as I told you, they all are needed to analyze the market from different perspectives. Some guys are trading using percent change, some guys are using Renko charts, ATR change, Pip change, some guys are using oscillators. Oscillators are the powerful tools to confirm waves in Elliott wave calculations. So you definitely don't want to be the only one who sees the pattern formation on the chart. What you want to be somebody who sees the formation that is seen to everybody. If the formation is seen to everybody, if it is obvious, then you have an advantage, because everybody is selling there at something that is obvious. If you want to force something, if you want to see something that is not existent, that is not seen to anybody, then you most likely fail. It is said in all these Scott Carney books, in all the Larry Pesavento tutorials on these patterns, and in all those Jason Stapleton like Killstokes webinars, that all the patterns that you are looking at, all the patterns, the nature of these patterns, they should possess a clear-cut W-type or M-type structure. So what is a clear-cut W-type or M-type structure? It is something that looks this way. This is M-type and this is W-type. That's it. So if you have something different, if it is like this, the price action is this, and you simply found the algorithm that draws a pattern, of course you can find one of them that can draw, especially with different settings, that can coincide and draw something here. It is what is called forcing the pattern. Yes? Of course you only want the pattern that is true pattern, that is seen to everybody. So this is the price action, and to check it you need to analyze the market from different perspectives, from different angles, and this is what makes the MPS 5.2 unique. No other software can do that. No other software can analyze the market from different angles. You are bounded with the algorithm that is provided by the programmer who programmed that software. You are bounded, and with MPS 5 you don't have these limitations. You are not bounded. You can check it from different angles, and you can set your own algorithm as well. You can set them to your taste, changing period, overbought, oversold condition. Okay. Of course, before changing something, before doing your own stuff, you need to do the backtest. I warn you to do the backtest, and MPS 5.2 is the best for that backtest, because it simply draws them on history if you're scrolling back. Of course, based on your variation, if you have automatic, yes, group 2 is not available for you if you have automatic, yes, and within group 1 you only have prex extreme, price extreme algorithm. Manual is disabled, stochastic disabled, RSI, commodity channel, 1% range is disabled, because automatic, MPS 5 automatic version is a limited version. It doesn't have all these functions that Pro version have. And if you simply want to have all the functions that has in Pro version, simply upgrade for Pro. It is very simple. You already purchased the automatic, and in order to get Pro you don't need to pay all the price. Simply pay the difference between these two variations. Simply pay the additional price, and you get your Pro. You see that? This is very convenient. Okay, and that's it about algorithm, and I hope to see you in my next video about the patterns.